What is up everybody, Gifford here and welcome back to another stock market video. So today's video I'm going to be talking about why I trade AMC stock. In the last video I showed why AMC was an unprofitable company, but in this one, even though it's an unprofitable company and it's quite risky, I show you why I trade it. So the agenda of this video is I trade it for massive premiums. I then go on to explain what put options are. I show a bit of my spreadsheet and an example of a trade I did in AMC on the 2nd of July. From there, I show you some examples of my IBKR options portfolio and what they kind of look like. I then go on and show how I pick my strike prices for AMC, and then we have a look at my options income, and then at the end, I give you my summary. So the very first reason of why I trade AMC stock is basically it gives me an annualized return of over 90%, which is huge. So this example I've got here in my spreadsheet below, which I'm going to talk about, is a trade that I did in AMC on the 2nd of July with options. They have an expiry date. So I started the trade on the 2nd of July and then I closed it, or automatically closed, on the 8th of July. So just following along with me, you can see here that I opened the trade up on the 2nd of July on AMC and I did a put option, which I'll explain a little bit later. My strike price was $12 and then that was to expire on 8th of July. And it's only one option and I got paid for that option was 22 cents. But as you know, you multiply that by 100 because it's over 100 shares. So really I got paid $22 and the commission fee that I had to pay with that was $1.05. And then we can see here that I actually closed that, or it automatically expired, which means that I got to keep close to $21. So here is a chart of AMC and we can see on the 1st of Friday that AMC price was $13.53 and I set my strike price to be $12. And then if we have a look at the time to see when the 8th of July happened, you can see that AMC was at $14.66, and because that was higher than my $12 strike option, I get to keep the premium. So let's just go back into the other slide so that I can explain that. So here what happened is that I got paid $22, and for the capital that it used up, because it was a put option, it cost me $1,200 that I had to set aside. So if you multiply this on an annual return, which is just the maths here, which is $22 divided by $1,200, if you times that by 52 weeks and then multiply that by 100, it gives you a 95% return. So as an example, if I wanted to make over $100 a week, I could do this trade 5 times and that would give me $110, but I'd need to have a capital of $6,000. By the way, this is just a generic example, not always the case due to the options trading mechanics, and these are just the basic components of it. So let's just quickly have a look at the definition of a put option for those people that are new, and this is part of the wheel options strategy. So what is a put option? A put option is an options contract that gives the owner the right, but not the obligation, to sell a certain amount of the underlying asset as a set price within a specific time. The buyer of the put option believes that the underlying stock will drop below the exercise price before the expiration date. The exercise price is the price that the underlying asset must reach for the put option contract to hold value. So I know that sounds a little bit confusing from that definition, so let's just have a look at my notes here and let's go through it one by one. So there is buying and selling put options. I sell put options for passive income, that's the point. So the previous example, I got paid $22 for selling a put option. So since I sold that put option, I also signed up to a contract with the buyer to buy 100 shares at the specified price, which was $12 at a set date. So the set date was 8th of July, and the price that I got paid to say that, hey, I'm going to buy the AMC stock for $12 or lower. So by selling that put option, I got paid $22, but my contract was AMC. I had to buy 100 shares of AMC if it was $12 or lower. And as you've seen on the 2nd of July, AMC price was $13.50. So I was pretty confident that it wasn't going to go lower than that. And you could see that it dipped down, but by the end of the 8th of July, it actually went up. So what happens is that I get paid the $22, and then that's it, the contract expires. But for them, the reason why the buyer would take it is basically it's an insurance policy for him. If it dipped even lower, let's say that AMC dropped down to $10, he could actually sell me those shares for $12 because I'd taken that contract up. And the reason that I would buy that is because he paid me the $22 in advance. So really we're both guessing where the price is going to be on Friday. And to him, he was happy to pay me $22 to make sure it didn't go down any lower, because if it did go down from $12 to $10, he'd actually lose $200. And in my case, I would be buying those shares that were only $10 each. I'd actually be paying $12 for them. So that is the risk that I take. So going back to this, my goal is for the price to be above $12 at expiry date, so then I can collect the $22 passive income. And my goal is to collect money each week without actually owning the stock, because I always want the stock price to be above my put price. So all I do is collect the premium every week. So to have an options trading account, you actually do need a lot of capital. While that trade was $1,200, I actually use a portfolio that has $15,000 in it, so I can do multiple trades. Obviously for risk management, I only do portions of trades in companies, and I like to do a little bit of different companies and try not to allocate too much capital to it, just in case I get the calls wrong or one option goes horribly bad. I'm not going to blow up my account. And on this page here, you can see transactions that I've done in AMC previously and also other companies as well. And on the right hand side, it's just more transactions. So the next part, I'm going to show you how I pick my strike prices to always try to make sure I am below the price at the expiry date. I'm going to show you that on TradingView, the support and resistances. And at the bottom, we're going to explain exactly what support and resistance and the Bollinger Bands are, which I'm using. So we're going to go over two charts. First one is TradingView, and then the next chart is Yahoo Finance, are the two tools I use. So we are over at TradingView, and you might be confused about the lines, but these are actually what they call the support and the resistance, or the other way around. So when a chart actually goes up and down, they break through these areas called a support and resistance, and we need these lines to try to predict where the stock is going to go and bounce back. So just a quick example, you can see that this line here is $11.50. So when it gets to this low here, or between these two bands, which is $14.35, I'm happy to do my options because I know that it's more likely to actually come above this line at a set amount of date. And then I know that when it goes above a little bit higher, like this one here is $17.50, it's likely to come actually all the way back down and to touch on this resistance here. So around this band is when I like to do my options. And again, if we get in this vicinity here, which is lower than $11.50 to $10.30, I know to definitely do some options in it because it's more likely to bounce back up. So as you can see here, once it's gone in this territory, it's actually come straight back up fairly quickly. So we've gone over to Yahoo Finance and have used the charting from there, and now I'm just going to explain to you another part of how I pick the strike price. So from the first chart of TradingView, that shows me sort of the range that it operates in and the support and the resistance, which is very, very important. But in this chart here on Yahoo Finance, it will actually show me how far it can move using the Bollinger Bands, which I have set to 2 standard deviations. So I'm going to talk about Bollinger Bands very soon, but let's just have a look here to show you how I pick my strike price. So let's just zoom in here so we can see it's clearer. And right now, the stock price is at $14.35. The lowest that it can move by is about $11.50. Or the highest at $17.50. So right now it's not really favorable for me to do options in this, but if I was to do options in this and I wanted to do a put strike price, I would make sure that it would be sort of around this $11.50. And remembering that if this was to drop below my strike price, I would have to buy 100 shares of that stock, which is something that I do not want to do, because even though I still collect the premium that I got of it, I would then have to buy the 100 shares. One of the biggest advantages of the Bollinger Band is you can see how the range is quite big, but at certain times you can see that the range actually narrows, and this is here is quite a good time to actually do the options trading. So more importantly, the definition for Bollinger Band. A Bollinger Band is a technical analysis tool defined by a set of trend lines plotted 2 standard deviations, positively and negatively. So we saw that in the chart, positively, negatively, away from a simple moving average. That's talking about the graph that's going up and down of a security's price. In this case, it was AMC, but which can be adjusted to the user's preference. So Bollinger Bands were developed and copyrighted by famous technical trader John Bollinger, so that's where he's got his name from, designed to discover opportunities that give investors a higher probability of properly identifying when an asset is oversold or overbought. So the most important part out of all this, the reason why you use the Bollinger Bands or that range between the two, is because approximately 90% of the price action occurs between the two bands. So 90% out of 100 probability happens between that. So while there is a 10% risk that it could go outside that, 90% of the time it's going to be within that range. So if you pick a strike price below the Bollinger Band, it's most likely not going to hit it. So hopefully you understood some of that, but I'll put down a couple of links in the description so that you can do some further reading. But the next slide here is my options monthly income and the reason why I do this trading. So we can see here that in May, between the 1st and the 30th, I was able to get $1,651. So I've got it broken down here with fees to include in it, because sometimes you do have to buy the options back. But anyway, I've broken it down and I've also converted it to New Zealand money here. If we have a look at this column here, which is New Zealand dollars weekly with the fees included in it, we can see that in May I made $400 weekly, and in June I made $341. And also in July, I'm currently making $225 a week, but we don't know yet because July hasn't finished. For me, this is a significant amount of money to be making weekly, which adds to my income. To summarize this, options is passive income, so my target actually is only $70 a week USD. However, I do average over $100, as you can see there. I use this money to invest in my long stock. So once this money accumulates, I then go and buy. Currently, I'm buying Google and Tesla stock when the prices is low. Otherwise, I just let it accumulate and wait for a time to buy. Also, I've chosen options because during the uncertain market, it kind of goes up and down, what we call a sideways market, which means that I can try to make money on the swings of the stocks going up and down. The other advantage of options is that it's sideline money. What I mean by this is that it helps me keep a nice cash position, as options money is only locked away for the duration of the options contract, unlike buying shares. So when you buy a share, you kind of spend your money and you get the shares back. With options, you kind of have to set money aside, but as soon as that expires, you get all that money back. So hopefully you get the premium and also the money back if you do it correctly. But what can be seen as a positive but also a big negative is that you have to be an active trader. So this involves more work with increased risk, but the gains are also increased, as you saw. However, after doing this for about a year with a bit of trial and error, I feel that options is actually safer than owning stock, as you can still generate passive income when the prices goes down, especially in a down market. If it was a bull market, it's actually better to hold stock, but I don't know what the future is, and during the sideways market, I think the options is quite appealing. Thank you very much for watching today. As always, feel free to subscribe if you're interested in any of the stock market investing, or in this case, options trading. Hit that like button to support the channel, and also feel free to follow me over on Instagram, as I post there every other day. Don't forget to always do your own due diligence and don't follow blindly other people's trades or anyone on the internet. The trading platform I use is Interactive Brokers, Hatch Invest, Stake and Sharesies for individual companies, and I use Investnow for index funds. If you want to start investing, you can use any of my referral codes down below to start your own investing journey if you are from New Zealand. With that said, thank you for watching, and I'll see you in the next one. Goodbye.